Today's episode is about understanding and not advocating. Welcome to the Purposeful Wealth Podcast. Bitcoin and crypto assets continue to generate strong opinions, from outright skepticism to passionate belief. As financial planners, investors, and perhaps your business owners, it's hard to ignore the topic, but equally important not to rush to conclusions. This episode is not so much a recommendation or an endorsement to invest in Bitcoin or crypto. Instead, it's really my hope that it will be an educational conversation designed to help you as listeners or viewers better understand what Bitcoin exists, what Bitcoin is, why it exists, the risks involved, and what financial planners and investors should at least be aware of, even if they ultimately decide that it has no place in their plans. I'm delighted to be joined today by Daniel Parkinson, whom I've got to know over the past year or so. Daniel's often referred to as the Bitcoin IFA, and he works with clients who are curious about Bitcoin and helps them understand it within the context of broader financial planning, regulation and risk. So I suppose my aim today is to ask the questions, or certainly many of the questions that advisors and investors are quietly asking, and to explore where Bitcoin fits, where it doesn't, and what we should really all know regardless of our personal views. So Daniel, welcome. It's lovely to have you here.
Thank you, Jonathan. What an intro. An absolute pleasure to be here, and hopefully we can demystify some of this for your listeners today.
Oh, thank you. I suppose just maybe a good starting point, Daniel, might be just for you to give a bit of a background to why you're called the Bitcoin IFA.
Sure, no problem at all. At this point, I've been in Bitcoin for about half a decade, just over. And I found Bitcoin because I found myself in Lebanon. So I moved out to Lebanon to do some volunteering. I was teaching English and football in a couple of refugee camps over there. And while I was there, Lebanon was experiencing hyperinflation. So for 30 years, their currency was pegged 1,500 lira to $1. And that peg maintained for about 30 years. When I arrived, the exchange rate had already fallen to 5,000 to the dollar. So it had already lost about 60% of its purchasing power. I exchanged $1,000 for 5 million lira on the black market, right, because the official exchange rate was still 1,500. And 3 days later, the exchange rate fell from 5,000 to 8,000 in one day. So suddenly my 5 million lira that bought $1,000 worth of stuff bought 60% less stuff. So it bought like $400 worth of stuff 3 days later. Now, we've obviously all done currency exchange throughout our lives, but we've never seen currency exchanges move that quickly. And so I reached out to a couple of friends of mine. I wasn't working in finance at the time. My background was in advertising and marketing and startups. So I reached out to a couple of friends of mine that worked in finance, and one that had been investing in Bitcoin since 2012, had been trying to get me to invest in Bitcoin since 2012. And it was a real light bulb moment, right? It was like, see, like, this is what happens. This is what is happening to all of our currency. It's just that what you experienced in 3 days, most people would experience over 3 years, 30 years, maybe. So then I was locked down in a hotel room in Lebanon for a couple of months, and I was able to go deep into the Bitcoin rabbit hole. I probably got to the 100 hours that it really takes to understand Bitcoin. I got to that within a week, like 100 hours of research. So, I was very fortunate to be able to go that deep that quickly. And then over the course of the next few years, decided that I wanted to retrain as a financial advisor, and I wanted to try and help people. I joined one of the larger restricted networks that I won't mention, and after a very short period realized that, in my opinion, I was harming people long term, not helping them with the funds that I was able to put them in. And so I left there about a year ago now. And I looked at the assets that I had, which is I'm a qualified financial advisor and I'm a Bitcoin expert. And I was like, right, let's see in the UK what that Venn diagram looks like, right? Qualified financial advisor and a Bitcoin expert. There's not many of us. I probably know all of them. And most of them are not prepared to go public. So then I was like, well, then let's give this a go. So I'm called the Bitcoin IFA. I'm no longer regulated or practicing. The name is a little bit to sort of put the cat amongst the pigeons, right? It grabs the attention of financial advisors. And I am now training financial advisors on Bitcoin and digital assets.
Okay, right. Okay. Yeah, it's a great introduction, and perhaps maybe helps to answer a later question about the problem that Bitcoin maybe solves around currency debasement. But anyway, I mean, for someone hearing about Bitcoin for the first time, I mean, how do you explain what it actually is, without the hype and without the jargon?
Sure. So Bitcoin is actually three things. Firstly, and this might take a little while, and I'm going to go off on a couple of tangents, Jonathan, but I'll bring it all back at the end, I promise. So firstly, it is the nexus point of decentralized technology money, right? So we have had decentralized money for thousands and thousands of years, right? It's called gold. And until 1971, our currency, so currency and money are different. So our currency, our pounds, our dollars, were backed by gold. Right? So even though we have centralized currencies through central banks, pounds, dollars, etc., the money itself, the currency itself was always backed by a decentralized money in the form of gold. Bitcoin has come along and basically taken all of the characteristics of gold and improved on them almost infinitely and layered on technology. And that actually leads very nicely into the second thing that Bitcoin is. So Bitcoin is a permissionless, pseudo-anonymous payment system, digital payment system. The example I always give here is if I give you £10, Jonathan, that is a bearer instrument that goes from me to you permissionlessly, anonymously, in real time. Bitcoin just does that, but digitally, because before Bitcoin, there was no way for me to give you £10 without some kind of third-party involvement. There had to be a bank, or there could be two banks, right? So from me to my bank to your bank to you. There had to be a PayPal involved, or whatever it is, there had to be some form of third-party involvement in the middle. So, but if I give you cash, we don't need to trust a third party. So Bitcoin came along and said, right, well, actually what we're going to do is invent a digital way that I can pay you money as a bearer instrument without the need for a third party involvement. And then the third thing that Bitcoin is a store of value. So a store of value is somewhere to place your economic time and energy. If I do a day's work today for £100, I have exchanged my time and my energy for £100 worth of currency. I need to put that £100 somewhere so that a year from now, right, in my opinion, and there is data to back this up, and I cover this in my workshops to financial advisors, the real rate of inflation, the real hurdle rate that we need to try and beat for ourselves and our clients is 12% a year. Right? If you're not achieving that, I believe you're falling behind in terms of purchasing power. If you want a real world example of this, just start tracking the things that you have to buy. Typically single ingredient food, steak, eggs, dairy, milk, butter. You can't hide the costs in those. So I need to place that £100 somewhere so that a year from now, it's worth £112 just to maintain the time and energy that I exchanged for it today, because I can't keep it as money. It's losing 12% purchasing power. That's why we invest. That's why I have to put it into a property or equities or whatever it is. So Bitcoin, in my opinion, is the greatest store of value that's ever been created. And that's because currently it's growing at 60% CAGR per year. It has grown at 120% CAGR since inception. It's forecasted to grow anywhere between 20 to 30% CAGR over the next few decades. And the reason it will do that is because it is finite in supply. There will only ever be 21 million. We'll come back to that. I'm sure we'll touch on that a bit later, but that's the reason why it will continue to go up in fiat terms so aggressively compared to other assets. So in answer to your question...
Just for our viewers or listeners, by CAGR, if I'm right, you're meaning compound annual growth rate, I'm assuming.
That's correct, yeah.
Okay.
Yeah. Circling that back, in answer to your question, Bitcoin, what does it do and why was it invented? Is for three things. One, it creates technological decentralized money, so money out of the hands of government. It's an electronic peer-to-peer payment system, so it's money, and it's a store of value. So if people ask, is it money or is it a store of value? The answer is it's both.
Yeah, okay. Yeah, which is what I think, I'm obviously on this journey like a lot of people. I always probably just dismissed Bitcoin as a medium of exchange. And now I would probably regard it as a digital asset, that it is an actual asset. And albeit there is obviously getting your head around that aspect is another thing altogether, the idea of a digital asset. But it's what it is. And you've probably answered, that was good. You've gone on to answer my second question, which was, what was the problem that Bitcoin was originally designed to solve? Do you think that this is going to just become, we're seeing across the West that countries are borrowing more, that in essence, you even hear some economists say the system's got to collapse at some point. Is this a real and present challenge or danger for many of us?
Absolutely.
Because countries can't just keep printing money, right?
They're going to give it a good go. They're going to try. The issue is governments borrow because they don't raise enough in taxes. The interest payments on that borrowing is accelerating, which means government borrowing is going to continue to accelerate. Milton Friedman said this in the mid-1970s, which is inflation has one single cause, and that is the over-borrowing or the overproduction of money by government. And that's it. Right? It's not the consumers, it's not the producers, it's not all the foreigners coming here, it's not the billionaires. It is government spending too much money that they don't have. That's the single cause of inflation. So if governments are going to continue to borrow more and more and more, we're going to see more and more inflation. Now, there is a lot of data that shows that inflation is nowhere near the government. CPI has not been anywhere near the government target rate of 2% for half a decade at this point. Yet in financial services, we're still taught to try and just beat the 2% hurdle rate of the CPI target. Even if CPI has realistically, like headline CPI has been somewhere between 3 and 5% for the last 5 years, but we're taught to only beat the 2% hurdle rate. I personally believe the real rate of inflation is double digit, somewhere between 10 and 15. I think it's about 12%. I believe there is data to show that. I do not think it is a coincidence that the S&P or global equities return 12% a year. Right? That's the cost of capital. That's maintaining your purchasing power. But that's likely to increase. And we're already seeing the odd headline. There is mootings about raising the CPI target to 2.5% or 3%. Right? It's already started in the US. We're going to see it here because there's just no way, with the amount of borrowing that governments are going to have to do just to meet the interest payment on the existing borrowing, that we're not going to be heading into an inflationary environment. So if you know that that's going to be happening, we're heading into an inflationary environment. Wages in this country have stagnated since the GFC. So we've got, in real terms, lower wages, asset price inflation, real price inflation. We need to look for alternatives. And often those alternatives are initially, what do they say? First they laugh at you, then they fight you, then you win. So, the alternative examples are going to be things like Bitcoin. And Bitcoin was specifically invented, in answer to your question, it was invented to take the power of money out of the hands of government, because we only have about a 2,000-year history of proof that government centralized power is terrible with money. Right? And we can go all the way back to the Romans.
Yeah.
The term debasement comes from the fact that they would, cut off parts of their coins, their gold coins, to then create more gold coins. Right. So, but the coin that had some of it removed was still, in theory, worth the same, whatever it was. 1 dinar equals 1 dinar, except the dinar is now 20% smaller, so that they can go and print more money. They essentially melt down that gold into new dinars. So we've got 2,000 years of history of proof that centralized forms of power and money are a terrible combination for the majority of people, right? For some, very good, right? It's called the Cantillon effect. The closer you are to the printer, the better off you get. But for the vast majority of people, they are not very close to the printer. Bitcoin removes that power of money from the government and puts it in a decentralized format. What that means is it incentivizes consensus among the whole network to prove all of the transactions. So it means everyone is involved in the power, in the governance of the money, and no single person, no single entity, no single government, corporation, etc., is responsible for that. We've never really had that before. And if you have more than one person in a room, you are never going to have 100% consensus on everything, right? If there's just by two people, this incentivizes consensus across hundreds of thousands of node runners at the moment, and that will become millions in due course.
Right. Okay. And people, people are often quick to lump everything together as crypto, but from your perspective, how is Bitcoin fundamentally different from other crypto assets? Is it down to this decentralization? Is that the issue that Bitcoin is decentralized, whereas other cryptocurrencies are not?
Great question. The short answer there is yes. Let me explain. So I would suggest that Bitcoin is analogous to digital gold, right? So decentralized, no central power owns it. There is no, right? We have companies attached to gold mining, right? But gold itself is decentralized. There is no company that controls it. There's no CEO. There's no marketing team. There's no lobbying team for gold. Bitcoin is digital gold. All of the other cryptos have some form of centralization, right? So Ethereum, XRP, Solana, you name it, right? I think there's millions of them at this point. They are analogous to VC-backed tech startups or penny stocks, right? So Ethereum, VC-backed tech startup, right? There is some technology behind that. It may prove to be worth something in future. Unicorn fart dust is a penny stock, right? It doesn't really have any value, right? It's for speculation alone. So all of the other cryptos have some form of centralization. They have a company behind them. They have a CEO. They have a founder. They have marketing teams. Some of them very, very successful lobbying teams. Some of them will provide some value 20 years from now, right? If you go back 20 years into the past, no one could have predicted the Mag 7. Right? Warren Buffett very famously missed the Google and Amazon IPOs. Right? No one could have predicted what was going to happen there. Meta didn't exist. Tesla didn't exist. Apple pre-iPhone were pretty irrelevant other than for computer geeks. And Netflix was still posting people DVDs. Right? So no one could have predicted the rise of the Mag 7 to what they are now. But 20 years ago, you could have predicted with some certainty that gold was going to be worth a lot of money 20 years into the future. So what I would say is from today, 20 years from now, Bitcoin will be worth a lot of money, and some of the other cryptos, which are analogous to VC-backed tech startups, will be worth a lot of money, but I can't tell you which ones.
Yeah, okay. And obviously Bitcoin's price swings, they're well documented, Dan. We've probably seen that in the last few months, I would think, where there's, the price has fallen. I mean, from a financial planning perspective, what behavioral risks does this level of volatility introduce for our investors from your perspective?
It's a really good question. It's actually a bit of an outdated challenge to Bitcoin, right? So 10 years ago, Bitcoin was wildly volatile. There's two parts to this. So firstly, as financial planners, we think in decades for our clients. And when you zoom out and think in decades, the 200-week moving average for Bitcoin has never declined. If you have bought Bitcoin and held it for a period of 200 weeks, it has a 99.8% hit rate of returning more than you invested, right? So not quite 100%. Nothing's perfect. 99.8% hit rate of returning more than you invested. So 200 weeks, 4 years, right?
4 years, yeah.
Which is in line with the FCA's investment period of 5 years, which is, so it aligns quite well. And in fact, the 200-week moving average just passed, I think, about $55,000, $56,000, $57,000, something like that, right? So look at the annual lows. Don't look at the annual highs and the volatility. And the annual lows go up and to the right, right? There is a very clear pattern. But that being said, in 2024, Fidelity ran a study that showed that Bitcoin's volatility sits right in the middle of the Mag 7. Right? So I can't remember which ones, but 4 of them were less volatile. 3 of them were more volatile than Bitcoin. And the same study showed that Bitcoin was actually less volatile than 92 out of the S&P 500. So almost 20% of the S&P 500 is more volatile than Bitcoin. And that was a study in 24 using 23's data. At the time, Bitcoin's vol was around 60, right? So it had the potential to move 60% in any year. Its vol over the last year has fallen to somewhere between 30 and 40, right? So the Bitcoin's volatility, as it becomes widely adopted, is falling very rapidly. Now, that being said, volatility in a diversified portfolio where there are rebalancing opportunities is not a bad thing, right? It's actually to be welcomed, because if you get Bitcoin's volatility to the upside and then you rebalance some of that every year, your clients are going to do very, very well. I show some data on this in the workshops. I'm not going to run through that now, but what it shows is that actually with very, very small allocations to Bitcoin, right? Anywhere between sort of 1 and 10%, that if you rebalance that annually, there is an asymmetric performance on your overall portfolio, and Sharpe ratio improves. It has historically been a very good addition with tiny allocations.
Yeah, okay. One of the challenges I probably have with it as a fiduciary for for our clients at Wells Gibson is that, we're probably very clear that an investment has an expected return. So if I invest in a company, I expect dividends and a share of that company's profits. And as companies do better and what have you, it's the value of its shares increase in price through, I suppose, supply and demand. You've said yourself that some would argue, you would say Bitcoin is an asset class. It's a digital asset. You would agree Bitcoin's a currency. It's a digital gold. But there are others, and probably where I am is still saying that Bitcoin is just pure speculation. And how would you answer that, or how do you think about Bitcoin conceptually?
Okay. It's a great question. So the first thing to say is Bitcoin is a money, not currency. So there's a bit of a difference. In the West, we believe it to be a speculative asset, right? So, okay, yeah, it doesn't technically give cash flow, and it doesn't have dividends, but its capital appreciation has outperformed everything for the last 16 years. So if you'd have bought $100 worth of Bitcoin 15 years ago, you could have been carving profits off the top of that as cash flow and still be a multi-millionaire today. Equities, there's another argument that I would use here, which is that throughout history, we have very documented periods with equities where we get sideways ranging for anywhere between 10 and 15 years. We are probably overdue one of those periods. We've just gone through a 17-year bull run since 2008. And from 2000 to 2012 was the last one. And there have been some larger ones throughout history. I think 65 to 80, obviously 29 to I want to say 40 something, 45 was another, right? So they're roughly about 10 to 15 years where we get this blow off top essentially in the stock market, and then we range for a decade and a half, and then we go on another run. During those periods, commodities tend to outperform equities. So a well-diversified portfolio would contain some commodities as a hedge against those periods, right? So some gold, maybe some silver, palladium, platinum, whatever. Bitcoin is a digital commodity. It's analogous to digital gold. So even if you believe it to just be a speculative asset, I would suggest to you that it is a hedge against inflation, currency debasement, sideways ranging in the stock market. And then if you're holding it in self-storage, in a cold wallet, so what's called on-chain, as opposed to, say, paper through ETF, ETN, it also prevents things like government overreach, things like bail-ins.
Just explain. So again, for listeners and viewers, Daniel's talking about holding it in a cold wallet as opposed to via paper. And Daniel said ETF, ETN, which is an exchange-traded fund or an exchange-traded note. Could you just maybe explain a little bit more about what the cold wallet is, Dan?
Sure. So a cold wallet is a way of basically taking self-sovereignty of your Bitcoin, which in the West we really haven't had to do since gold was essentially bailed in and centralized in the US in the 1930s, right? Prior to that, lots of people held gold. They held their own money. But since then, we've really only had paper notes or digital money, right? And no one keeps a large quantity of paper notes in their house. Bitcoin allows you to take complete control and sovereignty of your money with on-chain. Now, what that means is you essentially have, so all of the Bitcoin that will ever exist, all exists on the blockchain at the same time, right? So you don't actually remove it from the blockchain. What you do is you open a wallet that says that bit or that one Bitcoin on the blockchain is mine, because the last transaction for that Bitcoin was, say, you, Jonathan, sending it to me. So everyone on the network agrees that you sent that one Bitcoin from your wallet to my wallet. And all the cold storage does is it allows me to access that Bitcoin and move it. And I am the only one that can do that. So it's visible and it's 100% transparent on the blockchain at all times. So everyone can see that that one Bitcoin is in this wallet, which is just an alphanumeric code. So hence why it's pseudo-anonymous. Yep. And I'm the only one that has access to that wallet. Right? So what that means is, let's say the government comes and says, right, we're all in this together. we need everyone to give us 10% of their unrealized gains of their pension or their ISAs or whatever it is. If you own your house outright, we need 10% of the value of that. There is no way that you can prevent that from happening with any other asset. But with Bitcoin, you can. You can say, no, I'm not sending you that. Now, that obviously presents you with a problem. So you may have to emigrate, and you may have to emigrate to a non-extradition country. But you become completely self-sovereign of that money. Now, that obviously also creates a challenge, which is you become the single point of failure, which is not something that most people have ever had to deal with, right? Because we've always had it in a bank, or we've always had our pension with our financial advisor, right? So it's a new way of holding your money, as opposed to an ETF or an ETN, where you're buying that through your advisor, or you're buying that through your ISA platform or your SIP platform, but you don't actually hold the Bitcoin in that instance. The ETN provider holds the Bitcoin.
Right. Okay. So we're understanding that Bitcoin is an asset, and because it's backed by technology, it makes it a digital asset. It's a medium of exchange. It's money. It's not currency. So it's money, and its value is also the value in it compared to maybe other cryptos or other assets for that matter, or fiat currencies like the pound and so forth, or the euro, is that it's decentralized. But is its value, is part of its value in that there's a finite supply of this? That, I think in one of your workshops, which was a real eye opener to me, that you said that, and where we're at just now is that 94% of Bitcoin has been mined to date, and that the next 5% will take about 9 years to mine, and then 100 years to mine the last 1%. I guess I'm trying to understand, that doesn't sound like there's very much left to mine. That's number one thing that comes to mind. And number two, if there is scarcity in this, is it, why are more people not going down this route when they can clearly see how well it's done, as you've just said, over the last 15, 16 years?
Okay, you've opened up a couple of things there, Jonathan. Let's try and touch on all of these. So yes, Bitcoin's value is derived from its decentralized nature, yes, but the main value comes from its scarcity. As humans, we value scarcity. We always have, right? The reason why Erling Haaland gets paid £500,000 a week to play football, and why the vast majority of the billions of people that play football every week across the planet have to pay to play, right? If I want to go and play for my vets team, I have to pay subs, £5, £10, whatever it is. Erling Haaland gets paid £500,000 a week to play football. That's because he offers a skill set which is arguably a sample of one. Right? There are people that are comparable to him, maybe Kylian Mbappe, maybe a couple of others. But in terms of what he can do specifically, he is a sample of one. And so that scarcity is why he's paid so much money. And that goes the same for any industry, financial advisors, accountants, lawyers, whatever it is. As humans, we value scarcity, that you can do something or you offer something that very few can. Another example of this is gold. Right? Gold is very, very scarce. We've only dug about 2 Olympic-sized swimming pools out of the ground. That's all there is above ground. And we add about 2% of that, 2% new gold every year. It's called the stock-to-flow ratio. If you think, it's relatively finite. That's why it's always maintained or gone up in value. If you think of real estate, right? Lots of us would love to live in a rooftop penthouse in Mayfair, right? Or certainly within Zone 1 of London, or central Glasgow, central Edinburgh, whatever it is, right? We'd love to live in a 3-bed complex in Manhattan, right? But the reason most of us can't do that is because those things are incredibly scarce. There's not many of them that are in such a good location. So they're worth millions, tens of millions of pounds, because they're so scarce. and so desired, right? So the demand for them is very high and the supply of them is very low. Bitcoin is the first finite asset we have ever created. Every other asset, when demand or price increase, we can create more. We can create more debt. We can create more shares. So in the example you gave, right? And any company on earth could, in theory, just issue, double, treble its share count overnight, right? But it won't, but it could, in theory. We can make more houses. The only other asset where it's possibly truly finite is art by deceased artists, right? So we're probably not making any more Picassos, but we might find some more, right? But we can always, make more artists desirable. But with Bitcoin, there will only ever be 21 million. It is the first truly finite asset we have ever created. And you are absolutely correct. We're at about 95%. So about 19.5 million has been mined. So they exist already. 1.5 million roughly to be mined. And you're absolutely correct. By 2034, that figure will be 210,000 only remaining, and it will take 100 years to mine them. We are at roughly 3 to 5% global adoption now, right? So roughly 3 to 5% of global populace own some Bitcoin. We are still in what's called the early adopters stage, and the price has already run to $100,000, right? So you think with only 3 to 5% global demand, we're already at $100,000. What do you think? Right? The gains of any new technology are always made in the early majority phase, not in the early adopters, right? So, typically you get this S curve of returns, right? So, there's a thought experiment that I like to play with, which is there are roughly 60 million millionaires on the planet. What happens to the price of Bitcoin when all of them decide they need one? Because there isn't enough to go around. So if you can imagine that, coming back to the real estate example, the reason why Mayfair penthouses are so expensive is because everyone wants to live there. There's so much demand and very limited supply. Well, at the moment with Bitcoin, we've got tiny demand, 3 to 5% global demand, and it's finite in supply, right? There will only ever be 21 million. There's 8 billion people on the planet. What happens when we get to 20% adoption? 25%, 50% adoption, and there's only 21 million. And we're actually only mining just over 3,000 Bitcoin a week. So we're adding 3,000 new Bitcoin every week. At the last count, demand from Bitcoin treasury companies, which we may come on to, was over 10,000 a week. Right? So we're like, just one section of the market in Bitcoin treasury companies is already demanding 3x the new supply. So what happens when demand really takes hold and there is a finite supply of this asset?
So you're saying that 95% of Bitcoin that's been mined is owned by 3 to 5% globally. Is that what you're saying?
Yes.
And okay, so we often, I suppose our position with clients will often ask us about when we're building their portfolios, and we will tell them that we do this with a risk manager's hat on and not a performance manager's hat, and yet by focusing or by wearing a risk manager's hat as opposed to performance managers, our portfolios do really well in relation to because we are strong advocates of systematic investing, taking the risks that are supported by evidence and what have you, being globally diversified, keeping costs down, all that good stuff that is characteristic of a systematic approach to investing. And we will say to clients, we look at the 21 different asset classes, of which there are, 5 or 6 defensive assets, 5 or 6 growth assets, and the rest are what we would call alternative assets. And we won't include an asset class until we've, done our due diligence and it ticks all the right boxes. And I guess I suppose the stumbling block for me is Bitcoin and risk on the same page. And I suppose I'm keen to ask you. You know so much more about Bitcoin than certainly I do, Dan. But I mean, what risks do you spend most time talking about when it comes to Bitcoin? And I mean risks beyond price volatility.
Of course. People generally want to know about the security aspect. So it's because of its decentralized nature, it's probably one of, if not the most secure asset on the planet. Some of the threats to Bitcoin. Let's run through these. Quantum computing is one that's getting a lot of FUD right now. FUD stands for fear, uncertainty, and doubt. The short answer to quantum computing is it possibly presents a threat, but if it does, Bitcoin is a protocol, so we'll just upgrade the software and we'll upgrade the hardware. In the same way that the governments will have to do that, Google will have to do that, right? Meta, Amazon, they will all have to upgrade their protocols for quantum computing. Also, Bitcoin's encryption is comparable to things like air traffic control, nuclear launch codes. It's way more secure than things like government emails, government centralized data centers. So if quantum computing threatens the Bitcoin network, it's probably the least of humanity's worries, right? But it's a threat. Yep. Humans are a threat. Humans are unpredictable. So who knows what, in theory, you can get a 51% attack. So if you control 51% of the Bitcoin network, you could, in theory, damage it in some way. You could shut it down. Realistically, practically, we are beyond the point at which any single entity could add enough hardware and computing power to the network in order to control 51%. The US is probably realistically the only one that could afford to do it in financial terms. But as soon as one entity started coming for 51% of the Bitcoin network, the rest of the network would fight back. So more people would start adding their own nodes, and right. So theoretically, it's a threat. Realistically and practically, probably not. Complete internet outage or complete electricity outage, right? Those are real threats. But again, based on how much of humanity runs on electricity and the internet these days, I think a sustained down period for either of those, again, the Bitcoin network is the least of humanity's worries. Yeah. The only real threat that I can see to Bitcoin is if every government on the planet decided to start acting fiscally responsibly. And again, I come back to the fact that we've got a 2,000-year history to prove that is not going to be the case. So there are theoretically threats to Bitcoin. In practically, I don't think there are very many. The real threats actually come down to things like if you take control of your Bitcoin and you lose your wallet, that Bitcoin is gone, right? You can't get that back. So realistically, the threat comes down to an individual rather than the protocol itself, rather than the wider network.
Right. Yes. So there are some threats there, but when you explain them as you have done there, the question we've got to ask is how much of a threat is that really?
I mean, in my opinion, it's very, very low, less than 1% across all of them.
Yeah.
But as ever, one of the things that we often say in the Bitcoin community is don't trust, verify, right? So I'm standing here today as an expert. I've done the 10,000 hours of research that it takes to become an expert on something, but don't trust anything that I'm saying. Please go and do your own research, right? One of the things that the Bitcoin community is often accused of is being a cult. But if it if it is a cult, it's the only cult I've ever come across that encourages critical thinking and tells everyone in that cult to go and do their own
research.
Exactly.
DYOR, do your own research. Yeah,
exactly.
Yeah. I mean, how should UK investors think about regulation, custody, and the consumer protections when it comes to Bitcoin, and especially when compared to traditional assets?
Wait, are you asking for retail or are you asking for IFAs or financial advisors?
Yeah, maybe both. But yeah, I suppose the Purposeful Wealth podcast is ultimately aimed for our clients and prospective clients, and for the retail market. So I think that's probably a good starting point.
Okay, thank you for that. Okay, so then there's two sides to it. So the first is, if you're going to do on-chain, right, so self-custody, you probably want to have a pretty decent technological knowledge, right? If you would struggle to open an ISA for yourself, this probably isn't for you. You become the single point of failure, right? So do a lot of research before you start playing around with cold storage, cold wallets, right? Dip your toe in maybe by buying through an exchange. There are various exchanges. Coin Corner is a British-based exchange for Bitcoin only, right? If you wanted to support a British business, you can download that as an app on your phone. But eventually you're going to buy enough that sits on your phone that becomes too much, that if you lose your phone, you have to assume that money is gone. It may not be by the time you replace your phone and log in again, but it might be, right? So you become that single point of failure. Do a lot of research before you start playing around in that sphere, and you need to feel relatively technologically confident. If you're going to look on the other side and look at, say, an ETN, right? We've had various ETNs launch in the last few months. You can buy them in most platforms now. I believe AJ Bell and Hargreaves Lansdowne, if they haven't launched yet, they are launching at some point in Q1, but Interactive Investor, Aviva, lots of other Trading 212, I think lots of platforms have already launched the ETNs. If you're going to buy an ETN, think very carefully about how much you want to allocate to that. Are you prepared to ride out 50% drawdowns, which we've seen in the past? Mm-hmm. Are you investing an amount that you definitely will not need to touch over the next 4 years? Because if you hold it for 4 years, it has a 99.8% hit rate in the past of returning more than you've invested. So can you invest, ride out 50% drawdowns, knowing that the data would seem to suggest that if you hold it for 4 years, you will get back more than you invested? Can you do that? And then the main thing to really consider is that at present, at the moment, Bitcoin and other crypto products are not covered by the FSCS scheme, so the Financial Services Compensation Scheme, right? So if you do hold it on your phone on an exchange like Coin Corner or any of the others, and you lose your phone and someone takes it, that money is gone. Unlike if someone hacks into your bank or your credit card, you will likely get that money back through the FSCS scheme. But if they take your Bitcoin or your crypto, you won't. Similarly, if you invest in an ETN and something happens, Bitcoin goes to zero. In my opinion, it's not going to zero, but let's say it does. Or the ETN provider goes bust. Now, in theory, the ETN provider does have to back the asset, right? Unlike other ETNs, crypto ETNs do have to back the asset with the underlying asset. So in theory, it's there, but it may not be. Something may happen. It may go to zero. It's not covered by the FSCS scheme. So that's one thing to bear in mind. I would expect that to change in the next year or two, but for now, it's not. Yeah,
there's a lot to take in, isn't there? And I I suppose some of the skeptics would say, Jonathan, am I not getting access to, so many of these companies that you tell me my portfolio is invested in, these great companies of the world, are holding Bitcoin on their balance sheet. Is that not enough for me? That they're exposed to Bitcoin indirectly, virtue of some of these companies investing in Bitcoin. I mean, what would you say to that?
Okay. It's a really good point. And so for people listening and for any financial advisors listening, if you have any exposure to global equities, there is a very high likelihood that you already have exposure to Bitcoin, whether you want it or not. And as an IFA, whether you recommended it or not. Coinbase were added to the S&P 500 last May. Strategy, formerly MicroStrategy, are likely to get approved for the S&P 500 this quarter. Tesla hold Bitcoin on their balance sheet. Mercado Libre, which is the South American Amazon, hold Bitcoin on their balance sheet. You likely have some exposure to all of those companies that I've just mentioned if you have global equities. So you're already benefiting from Bitcoin exposure, whether you want to or not. But the asymmetric upside is in direct exposure. Right? So that Bitcoin is lost within a balance sheet, other than strategy, which are slightly different. And by the way, Vanguard are the single largest holder of strategy shares. They own about 15% of the company for index investing. So, if you have some global equity exposure through Vanguard, you probably already have strategy exposure, despite the fact they're not in the S&P 500 yet. Strategy is slightly different. We'll touch on those in a second. What I would say to you is this. Imagine you could go back to 2017, 2018, and just move a very small percentage of your portfolio into the underlying technology of AI. So right now, AI has pretty much been centralized into about 5 companies, right? So it is Google, Meta, Microsoft, Amazon, Apple, Tesla, right? So what's that, 6, I think. Even if AI 5x's all of their balance sheets over the next few years, that still doesn't hugely move the needle on your clients' portfolios. Right? It will have a positive impact, but it's not massive. But if you'd have invested in the underlying technology of AI, that would have, right? Even a 1 to 2% allocation 10 years ago would have massively moved it. I'll give you some real world stats on this. There's a chap called Pete Dunworth. He's a financial advisor in Australia. He's got about 30 years of experience. He moved 1% of his clients' portfolios into Bitcoin in 2016. It has done 150x since then. His clients' portfolios have gone somewhere between 2 to 3x. His firm's revenues have gone somewhere between 5 to 10x in 9 years. If there is another asset that has the possibility to 2 to 3x your portfolio from a 1% allocation, or to 5 to 10x your firm's revenues from a 1% allocation over the next decade, please tell me what it is. I want to invest in it. I want to invest more than 1% into it. But to my knowledge, Bitcoin is the only one. Right? So there is a huge opportunity for asymmetric upsides from a 1% allocation directly into Bitcoin, rather than losing it diluted within a balance sheet. And I think, a 1% is a good starting place, right? 1% is a bad day in the stock market. If you move 1% of your clients' portfolios into Bitcoin and it goes to 0, it's not going to 0, but if it goes to 0, your clients will probably have to retire 2 or 3 months later than originally planned, right? If you're using cash flow modeling tools. But if it goes 100x from that 1% allocation, your clients can probably retire, 5 years earlier, 10 years earlier. So that's the potential asymmetric upside from a very tiny allocation.
Yeah. And what's the, for most for most clients that are investing for the future, they're doing that through their pensions and, through a private pension or perhaps a stocks and shares ISA or maybe even a general investment account. I mean, how can how can the general public, if you like, using their pension, get access to this asset class, Dan?
Great question. So if it's through a SIP or an ISA or a GIA, general investment account, depending on which platform you're using, you should be able to find Bitcoin ETNs on there. And as I say, I think Hargreaves Lansdown and AJ Bell are the final two dominoes to fall, and I believe they've either already launched as we record this, or they're launching very shortly. They said early Q1. Most of the others have already fallen. So I have accounts with Interactive Investor and Trading 212. I can buy Bitcoin ETNs on both of those platforms. You have to pass a short questionnaire, and you have to, I think you apply, pass a questionnaire, and then you have a 24-hour cooling off period. Mm. If you use a financial advisor, speak to them about it. Financial advisors, it's slightly trickier, but I know that of at least two platforms that have already launched them, in AJ Bell and Aviva. But if you have a financial advisor, what I would say is go and speak to them about it. Ask them if they can get you some exposure. If not, ask them why. Have conversations about it, and that's all I would suggest is, just start doing a bit of research and have some conversations.
I said to you just at the outset before we recorded today's podcast, and I had said that I liked you had written something about Bitcoin to say Bitcoin's for anyone, but it won't be for everyone. In other words, it is available to anyone, but it's not going to be the right thing for everyone. And I suppose part of that will be, we have a lot of clients who, have, there's contentment's a big thing. I actually increasingly do think that the true definition of real wealth is contentment. If you can be content with whether you have little or whether you have a lot in your life, there's a lot to be said for that. And I suppose a lot of clients, we have a lot of clients, majority of our clients could easily be, have 100% of their portfolio in what I refer to as growth assets or global equities, global shares. And yet what will stop them is they don't have the stomach for the volatility, regardless of you could speak to them about the charts and, that their portfolio represents real companies producing real goods and real services for real people. And some people are just, they just don't like when there's a fall. They're maybe worried about how long that downturn could be. And there's also the issue where people realize not just contentment, that financially they're probably not going to run out of money. They've got enough. And so they think, I don't really need that extra return. And we'll do all we can, obviously not to take people out their comfort zone. We have a job as a fiduciary and responsibility to our clients not to take people to the edge of the cliff, as it were. But, what's from your perspective, without making any recommendations, and what theoretical circumstances do you think that Bitcoin might be discussed, within a broader financial plan?
Yeah, really good question. It's going to be entirely subjective, but for the sake of today, let's break it down by demography. Your retirees may have enough, right? You may have done cash flow modeling and said, do you know what? You're going to be fine. Let's not take unnecessary risk. Totally get that. The over half of Bitcoin owners in the UK are in the 35 to 54 age range. These were the first, I'm in that age range. We were the first generation to really start to see the stagnation of wages and a massive increase in asset prices. So we're trying to bridge that delta somehow, right? Lots of people are having to make the decision between having children and owning a house. The younger generations, 18 to 34, they actually over-index in crypto because they're chasing the next 1,000x in the next 15 minutes, not the 20 to 30% CAGR over the next 20 years that Bitcoin is forecasted to have. So they're really trying to bridge that delta where, you know, the average house price in the UK is 10x the average salary. How do you bridge that delta? So depending on where people are in their financial journey, they're going to be prepared to take more risk, right? I say, you know, if someone's 16 years old and they work in Tesco's on minimum wage, they've got nothing to lose by saving 100% in Bitcoin because they're starting from zero. Right? If that shoots up to 20,000, 30,000, 50,000 in the next few years, suddenly they've got something to lose and they may want to diversify out of that. So it really depends on where people are in their journey and what their personal risk appetite is. But what I will say is that if the consequences of government borrowing that Bitcoiners fear come to pass, everyone will need Bitcoin and they will be playing catch up. And the price of Bitcoin in fiat terms will just be going up and up and up as more and more people try and get their hands on this very finite asset. So I would suggest that everyone does their research, right? Start researching and just get off zero. Buy £10 worth. See what happens.
And explain to me what's the, you know, that's often been said, there's no point in having a £1 million on a desert island, you know, if you like. And if someone builds up a bit of wealth on with Bitcoin, how do they realize that value?
Great question. And actually, I love that example you gave because it's one of the counter arguments to people saying that Bitcoin has no intrinsic value. And I'm like, okay, but intrinsic value implies, you know, it's based on how I value it. If you're drowning in the middle of the Atlantic Ocean and a boat comes past and they offer you the choice between a trip back to shore or £100 million of gold that you've got to hold, you're going to take the trip back to shore, right? So the intrinsic value of 100 million of gold in that moment is actually zero because you're choosing the other choice.
Yeah, I suppose it's how people realize the value, you know, whether people have a cold wallet or they use a platform, you know, like Strike, or, you know, they're able to allocate some of their pension, let's call it 1% of their pension to exchange traded note. I mean, you know, and all of a sudden it grows 10 times or whatever. You know, how do they realize that value? There has to be a buyer on the other side, right? If you're going to sell something, there needs to be someone that's prepared to buy it, which is what makes the, you know, equity market so liquid. And for every seller, there's a buyer, right? So, and that's what sets the price. So, what's you know, how do, in practical terms, what's the process for realizing value?
Well, you can always sell Bitcoin. So Bitcoin is globally traded 24/7, 365. It's the most liquid asset we've ever had. There's always a buyer of Bitcoin, right? Even if it's the market makers, the OTC desks, which is the over-the-counter desks. I mean, on that, Bitcoin has been trading for 15 to 16 years, something like that. It's actually traded over 140,000 hours in that time. The stock market in total has only traded 100,000 hours since 1971. We use 1971 for two reasons. One, it's when we came off the gold standard, and two, is when the NASDAQ was launched. So Bitcoin has actually traded 40% more than the NASDAQ in a decade and a half than the NASDAQ has done in 5 decades, right? So it's the most globally liquid. The way to realize the value is either to sell it, or, and people are very reticent to sell their Bitcoin. We have something called hodling, which stands for hold on for dear life, HODL. And the reason people tend to want to hold on to their Bitcoin is because when you price things in Bitcoin, everything's getting cheaper, right? So I'll give you a real world example of this. 2010, the average house price in the UK was £166,000. That would have cost you 2.8 million Bitcoin. In 2024, that same house is about 297,000. So it's basically doubled in price. Now, let's not beat around the bush here. What's really happened, right? Because one house still equals one house, the value of the pound has halved. It takes twice as many pounds in 2024 to buy a house than it did in 2010. That same house in 2024 would have cost you 5 Bitcoin. 2025, it would cost you 4 Bitcoin. Actually, with the price now, I think it's back to 5. At one point, it would have cost you 3.5 Bitcoin in 2025. It's back down to 5 at the moment. Pretty soon, that will be 0.5, then 0.05, right? So when you price things in Bitcoin, everything's getting cheaper. So then why would you sell your Bitcoin, right? Why? Like, something has to provide you with such value for you to part with something that you know a year from now is likely to be worth more money. And the thing you buy is likely to be worth less. Most assets depreciate, right? Maybe not assets, commodities, cars, right? Go down in value, whatever it is, right? You're not going to sell some Bitcoin to buy a kettle, right? So someone has to provide you serious value for you to sell your Bitcoin, which is why we now have a secondary market that's sprung up on top of Bitcoin so that you can borrow against your Bitcoin. There's a great company, there's lots of others, but there's a great company called Ledden, founded by a Venezuelan, grew up in hyperinflation. And, the same way that I found Bitcoin, he found Bitcoin. They will lend you fiat against your Bitcoin so that you don't have to sell your Bitcoin. They do it in a way that doesn't create a sellable event or a taxable event. So some do, some don't. So there will be a sellable taxable event for capital gains. Some do it without. And you don't pay tax on debt.
No, that's very true. Yeah, thank you for that. So listen, just my final question. I mean, for clients of Wells Gibson, or maybe this applies to financial planners as well, and other investors that might be listening to this episode or watching this episode, for those people who feel strong, fear of missing out, that FOMO feeling, or those people with strong skepticism. I mean, what questions, 1, 2, maybe 3 questions should they be asking themselves before actually forming a view on Bitcoin?
I mean, the first question I would always ask is, why does my money melt? Why can't I keep my money as money? Like, why when I was a kid were Freddos twice the size, half the price, and significantly better quality? A quarter of the price, twice as big, a quarter of the price and significantly better quality. Why are foodstuffs having to get reclassified as chocolate flavored rather than chocolate bars? Why don't my cats want to eat ice cream anymore? Because when I was a kid, they always wanted the ice cream, but now they don't want the ice cream because there's no dairy in there. So just start questioning why are things getting so expensive? Don't just observe that they are. Go to the root cause. Why are they getting so expensive? And there's a great video that I would always recommend to people to watch. Anyone in financial services, I believe this is essential viewing. But I would also say it's essential viewing for any of your listeners. And it's a video by Joe Bryan. It's called What's the Problem? It's only 30 minutes. And I think it is the most enlightening video you will ever watch.
Yeah, I've watched it, and it's probably the video that was recommended to me to watch as part of my part of my journey here. Yeah. Dan, listen, I just want to thank you. I think this has been a really thoughtful and measured conversation. And, I'm still on this journey along with a lot of other people, both, from a personal perspective as a dad for 3 daughters and not to mention as a financial planner or fiduciary to a number of great clients at Wells Gibson here. But, what I hope listeners or viewers will take away from today isn't a push towards Bitcoin, not a push away from it, but something far more important, and that is clarity. Bitcoin clearly sits outside the comfort zone of many traditional investors, and equally it attracts strong conviction from others. But as we've discussed, ignoring something simply because it feels unfamiliar, that's not good planning, and embracing something without fully understanding the risks isn't good planning either. This episode hasn't been about returns or predictions or promises. It's been about understanding what Bitcoin is, what it is, why it exists, and where the risks lie. So for some people, I think that understanding will reinforce the decision to have no exposure at all. And for others, perhaps they'll be happy to do so and to expose money towards this asset class. But Wells Gibson, Purposeful Wealth, we feel Purposeful Wealth is ultimately about making decisions that are aligned with our values and our desired lifestyle and our capacity to take, or our capacity to deal with volatility, and not by following headlines, hype, or fear of missing out. So I just want to finish to say, if today's conversation has done one thing, I hope it's encouraged people to slow down, get educated, and make decisions deliberately rather than, for deliberate reasons rather than emotional reasons. Daniel or Dan, thank you again for sharing your perspective so openly, and for helping bring what is a complex and polarizing topic into a more balanced and thoughtful conversation. Thank you very much.
Pleasure.